The United Nations estimates that somewhere between $800 billion and $2 trillion gets laundered every single year. That's up to roughly 5% of everything the entire world earns, washed clean and made to look legal, every 12 months. By the end of this video, you'll understand why a painting can be worth whatever two people simply agree it's worth, and why that one fact turns art galleries into laundering machines. Why walking into a casino with a suitcase of dirty cash and walking out with a cheque is, for decades, one of the oldest tricks in the book. Why buying a house through a company nobody can trace back to you is completely legal in most of the United States. And why one man used all three of these tricks at the same time, buying Picassos, gambling millions at a single blackjack table, and snapping up mansions through shell companies, to hide a theft so large that the US Department of Justice called it the biggest case its kleptocracy recovery team has ever handled. We'll explain exactly how each trick works, simply enough that it'll actually make sense, and then show you how one real person got caught using all three at once. Let's start from the very beginning. Imagine you got a huge pile of cash from doing something illegal. Maybe you sold drugs, maybe you stole it, maybe you took a bribe. Here's the problem. You can't just walk into a bank and deposit $1 million in cash without the bank asking a lot of very uncomfortable questions. Banks in the US are legally required to report any cash deposit over $10,000, and they're trained to notice anything that looks suspicious even under that. So you have a pile of money that's completely useless to you unless you can make it look like it came from somewhere normal. A job, a business, an investment. That's the entire goal of money laundering. Taking money that looks dirty and making it look clean, the same way you'd wash a muddy shirt so nobody can tell it was ever dirty. Experts usually describe this in 3 simple steps. First, placement, getting the dirty cash into the financial system somehow. Second, layering, moving it around through enough transactions that nobody can trace it back to where it started. Third, integration, getting the now clean-looking money back into your pocket in a way that looks completely legitimate. Art, casinos, and real estate are 3 of the most popular tools for doing exactly that, because all 3 share one thing in common. It's genuinely hard for anyone, even the government, to say exactly what they're worth. If you're enjoying this breakdown, hit subscribe. We go inside a different industry's real numbers every episode. Here's the simplest way to understand why art is so useful for hiding money. A painting is worth exactly whatever the last 2 people who traded it agreed it was worth. There's no factory price, no government set value, nothing to compare it to. A canvas with paint on it could reasonably sell for $500 or $50 million, and nobody can definitively prove either number is wrong. That single fact makes art perfect for 2 different tricks. The first is simple overpayment. You buy a painting from yourself, using a friend or a shell company as the middleman, at a wildly inflated price. Say the painting is really worth $50,000. You pay $5 million for it. Congratulations, you've just turned $5 million of dirty money into a painting, a completely legal asset, and when you eventually sell that painting for a normal price, the money that comes back looks exactly like ordinary art sale income. The second trick is even simpler. For most of history, high-end art sales didn't require anyone to prove who was actually paying, especially through private dealers, auction house intermediaries, or storage facilities in tax-free free ports, where art can sit for years, changing hands, without ever technically entering any country at all. In the US, art dealers weren't even required to follow the same anti-money laundering rules as banks until a law change in 2021, meaning for decades, buying a multi-million-dollar painting required less paperwork than opening a checking account. Here's the casino trick, and it's honestly the easiest one to picture. You walk in with a bag of cash, buy chips, sit at a table for a little while, barely play, then cash the chips back in, and the casino hands you a check or a wire transfer instead of cash. On paper, that check just looks like gambling winnings. Nobody at the bank receiving that check knows or necessarily asks whether you actually won it or just paid yourself back your own dirty money. Big casinos actively want high-rolling gamblers, sometimes called whales, because whales lose enormous amounts of money on average, and that's the casino's whole business model. But because whales are expected to move huge sums of cash in and out, unusually large transactions are easier to hide inside behavior that already looks normal for a high-stakes gambler. even when regulators require casinos, like banks, to report big cash transactions and suspicious activity. Here's the real estate trick, and it depends on one specific legal gap. In most of the United States, you can buy a house through a limited liability company, or LLC, without publicly disclosing who actually owns that LLC. So instead of buying a $10 million mansion under your own name, you set up an anonymous shell company, and that company buys the house instead. On paper, the buyer is just 123 Holdings LLC, a name that tells absolutely nobody who's actually behind it. You get a beautiful, completely legal asset, and because real estate tends to hold or grow in value, you can sell it years later, and the proceeds look exactly like a normal real estate sale, no different from any other homeowner cashing out. This loophole is such a well-known laundering tool that US regulators created special rules specifically targeting all cash real estate purchases made through shell companies in certain high-value markets, requiring title insurance companies to identify the real humans behind the LLC. But those rules only ever applied to a handful of cities and a narrow slice of transactions. Most of the country was never covered at all. Notice the pattern connecting all three. Art, casino chips, and real estate all share the same underlying weakness that makes them so useful. Their true value is subjective or private. Ownership can be hidden behind a company or a private sale, and none of them move as fast or as visibly as a bank wire, which gives the money time to look like it belongs wherever it ends up. That's the trap inside all of this. None of these three industries is inherently illegal or shady on its own. Art galleries, casinos, and real estate agents mostly deal with completely honest customers every single day. The trick works precisely because it hides inside something that looks completely ordinary. Now let's watch all three tricks happen in one real story. Between 2009 and 2015, a Malaysian financier named Joe Low is alleged to have helped siphon more than $4.5 billion out of 1MDB, a Malaysian government investment fund that was supposed to be funding public development projects. According to US Department of Justice civil forfeiture complaints, Low didn't just sit on that stolen money. He spent years spreading it across exactly the three tricks we just walked through. On art, prosecutors say Low spent roughly $200 million buying paintings by Picasso, Monet, Van Gogh, and Basquiat, some purchased through private deals specifically structured to obscure who the real buyer was. On casinos, court testimony from a Las Vegas casino executive revealed Low wagered close to $87 million at a single casino's VIP baccarat tables over the years, at one point losing $1.75 million in a single 90-minute session. The kind of extreme, high-volume gambling activity that made enormous sums of money moving in and out look, on its face, like nothing more than a wealthy gambler's habit. On real estate, prosecutors traced stolen 1MDB funds into luxury properties in Beverly Hills, New York, and London, several purchased through shell companies and trusts, designed specifically to keep Low's name off the paperwork. It eventually unraveled. US investigators built a civil forfeiture case that became the largest in Department of Justice history, ultimately recovering over $1 billion in assets, real estate, artwork, even a 300-foot superyacht. And Low himself was criminally charged with conspiracy to commit money laundering. He remains a fugitive, believed to be living in China, having never faced trial. But the money, the art, the houses, the winnings, got seized piece by piece. Years later, once investigators worked backward through exactly the trail we just described. Money laundering isn't really about criminals being clever with math. It's about finding corners of the economy where nobody can easily answer one simple question: what is this actually worth, and who actually owns it? Art, casinos, and real estate all share that same soft spot, which is exactly why, no matter how many rules regulators add, these three keep showing up, again and again, in the biggest laundering cases in the world. The dirty money was never really cleaned. It just got dressed up as something ordinary. A painting, a gambling win, a house, good enough to pass, until, sometimes years later, someone finally asks the right question. If you want the deeper version of this, how businesses and financial systems like this one actually work step by step, check the channel for more videos, and it's worth a look no matter which topic you're most curious about. If this video helped you understand money laundering a little better, Go ahead and like it and subscribe to the channel if you haven't already. Thanks so much for watching.